What would you do if your mortgage broker solved your renewal and quietly cost you $34,000 in a single year? That's exactly what happened to a self-employed homeowner in Brampton who got renewed out of an alternative lender and straight into a private one. He didn't fall behind. He didn't miss a payment. His broker just moved him, and the meter started running. I read the fine print so you don't have to. Non-bank mortgage lending in Ontario ballooned to $22.4 billion by 2021, according to CMHC data reported by CBC. And a huge share of those borrowers have no idea how much it's costing them. Today I'll show you 3 moves: audit your lender type, quantify your true borrowing cost, and build a written exit before your next renewal. Here's the number that should stop you cold. In the third quarter of 2023, CMHC reported that nearly 1%, 0.96%, of private lender mortgages were delinquent, compared to just 0.15% across the entire Canadian mortgage industry. That's over 6 times the default rate. But here's the part nobody tells you. Most borrowers don't even know they're in that riskier bucket. So here's the plan. 3 moves: audit your lender type and renewal path, quantify your true borrowing cost, including every fee, and build a written exit strategy before you renew again. Here's the mechanism. When you can't pass the federal stress test or prove stable income at renewal, a broker may fix it by moving you from a regulated alternative lender into a private lender. The Canadian Alternative Mortgage Lenders Association, CAMLA, the group that represents structured non-bank lenders, draws a hard line between the two, because private lenders often operate with far less oversight and approve you on home equity, not income. And the cost of that switch is brutal. On a $500,000 mortgage, an alternative lender at 6% with a 1% fee means about $30,000 in annual interest plus a $5,000 closing fee, according to Money Sense. Renewed into a private lender at 10% with 3% in layered fees. Per Metro Mortgage Group, that interest jumps to $50,000 and fees to $15,000, roughly $30,000 extra in year 1 alone. Now the second layer, and it's the quiet one. Private mortgages in Canada typically run just 6 to 12 months. They're often interest only, and they stack fees: renewal, discharge, legal, broker. Per Metro Mortgage Group, effective borrowing costs can top 14% once fees are counted. So instead of paying down principal, your home equity is being spent just to service the debt. And that erosion is exactly what makes people lose their homes. Land Bank advisors studied over 1,000 GTA mortgages issued between 2020 and early 2024 and found about 90% of borrowers forced to sell after default had private lender mortgages, with MICs behind more than half. Reported by CTV News. Every month you stay is another month your cushion shrinks, and a market dip or income shock can push you over the edge. Here's the belief that keeps people stuck. Private mortgages are just a slightly higher rate bank loan, fine to renew into. Not true. CAMLA explicitly separates regulated alternative lenders from loosely overseen private ones, and CMHC's delinquency data proves private loans carry far more risk. Put both costs side by side. One switch costs about $34,000 extra in year 1, based on Money Sense and Metro Mortgage Group figures. But repeated cycling, 3 separate 3-year private stints over 20 years, could top $375,000 in extra interest and fees, on my own conservative modeling of those rates. Let me make this real. Meet Ravi. He's 42, a self-employed contractor in Brampton earning about $95,000 a year with uneven cash flow. His townhouse is worth $750,000. He owes $525,000, and he just got renewed from an alternative lender into a private one after failing a bank income check. Here's what he found. Discovery 1, $34,000. His alternative lender had him at 5.5% plus a 1% fee, about $28,800 in annual interest and a $52.50 closing fee per Money Sense. The private renewal? 10% plus 3% in fees, $52,500 in interest and nearly $16,000 upfront per Metro Mortgage Group. That's about $34,000 more in a single year. Discovery 2. He's now in the most dangerous slice of the market. CMHC data show private lender mortgages carry a delinquency rate of nearly 1% versus 0.15% overall, over 6 times higher, reported by CTV News. And in the GTA, about 90% of borrowers forced to sell after default had private loans. Ravi didn't just get a worse rate, he got worse odds of keeping his home. Discovery 3, and this is the one that really hurts. If Ravi cycles through private renewals for 3 years at an effective 14% on $525,000, that's about $73,500 a year. Roughly $220,000 over 3 years per Metro Mortgage Group. A 6% alternative loan would cost about $94,000. That's a $126,000 gap, funded straight out of his equity. Now stretch that across his working life. If Ravi keeps getting renewed into private 3 separate times over the next 20 years, each stint costing about $126,000 more than a 6% loan, the cumulative extra cost is roughly $375,000. That's my conservative estimate based on the Money Sense and Metro Mortgage Group rates. That's a retirement gone to interest and fees. So, could this be you? 3 signs. You renewed after failing a bank stress test or income check. You genuinely don't know if your lender is alternative or private, and you've never seen a written plan to get back to a bank. If any of those ring true, the next 3 moves are built for you. These 3 moves cost you nothing but an afternoon, and they're the difference between escaping this trap and paying for it for decades. First, you find out exactly what kind of lender you're actually in, then you calculate what it's truly costing you, and finally you lock in a written plan to get out before your next renewal quietly rolls you deeper. Move 1. Audit your lender type and renewal pathway. Pull out your mortgage commitment letter and write down the lender's legal name, your rate, the term length, and every single fee listed. Then search that name in your provincial regulator's public registry, in Ontario that's FSRA, to confirm whether you're with a licensed alternative lender or a private MIC or investor group. Here's how, in 3 steps. Find your commitment letter and list your rate, term, and all fees. Search the lender's name in the FSRA registry. Then ask your broker, in writing, what the planned renewal path is. Good looks like this: a regulated bank or alternative lender, not an opaque private loan. Move 2. Quantify your true borrowing cost because the rate alone lies. Add your annual interest to every fee: lender, broker, renewal, discharge, legal. Then annualize any one-time fees over your term. $15,000 in fees on a 1-year term is $15,000 a year per Metro Mortgage Group. Compare that total to mainstream alternative rates of about 4 to 6%. 3 steps: list your rate, balance, and every fee from your documents. Annualize the one-time fees over your term length. Then add interest plus fees to get your effective cost in dollars and as a percentage. Good looks like an effective rate at or below 7%, nowhere near that 14% danger zone. Before I get to the last move, which is the most counterintuitive part of all this, and the one that actually gets people out, here it is. Move 3. Build a written exit strategy. Gather your tax returns, notices of assessment and credit report, then work with a regulator license broker to see exactly what's blocking you from a bank today and set a real path back. 3 steps. Pull your NOAs, bank statements, and credit report. Set concrete targets and a 6 to 12 month refinance timeline with a licensed broker. Then put it in writing: target lender, documents needed, and how you'll handle exit fees. Good means the private term is used once, 12 months or less, with a dated exit. If breakdowns like this are useful, subscribe. The next one's already coming. And why does this matter right now? In 2018, the federal stress test tightened and pushed borrowers out of prime lending into alternative and private loans. Between 2019 and 2021, non-bank mortgage value in Ontario jumped from $13 billion to $22.4 billion, per CMHC data reported by CBC. Then in 2023, CMHC's delinquency figures and that GTA forced sale research turned a spotlight on the segment, which is exactly why a timely exit matters more than ever. Once you've acted, verify it. You should see your lender's exact category confirmed in the FSRA registry. You should have your effective annual cost written down in both dollars and percentage. And if you're private, you should have a dated refinance target with a named lender in hand. Everything here comes from CMHC, CTV News, CBC, Money Sense, and CAMLA. The real filings and studies, not my opinion. I've linked every source below so you can check the numbers yourself. So now you know how the private lender renewal trap works and the 3 free moves to escape it before it costs you a retirement. Next, I'm covering how mortgage investment corporations actually profit when borrowers default, and why that changes who's really on your side. That one connects directly to everything you just learned about who's holding your loan. If you want to catch it, subscribe now so you don't miss it, Akron, because the fine print never stops working against you.